welcome back. You're watching Financial Planner. I'm in conversation with Certified Financial Planner Sumit Ved. We're going through viewer emails. If you want to get in touch with us, you can always email us at financialplanner@utvmoney.com. You can always find links to the show on our website, utvmoney.com. You can also find us on Facebook because everybody is on Facebook. Go to facebook.com/Smriti Rao. Alright, so we got an email from a 23-year-old, not on Facebook, but regular email. He says, I want to start an SIP in MF. Lots of jargon, so he wants to start a systematic investment plan in a mutual fund. But he says that right now, it's really hard for me to figure out which fund would work the best for me, which mutual fund would work the best for me. So he's looking at a bunch of mutual funds and he's a little confused. He says one of the funds, NAV, is approximately 35 rupees. On the other hand, there's this other fund and that's approximately 200 rupees NAV. So I'm confused which of these two funds is better. The difference between the NAVs is pretty high. Remember, one is just 35, the other is 200 rupees. He says, how do I judge which one is better, and do the NAVs actually signify anything? And so let's start with that, Sumit. So just very basic. So you look at a mutual fund and we keep talking about it in a very offhand manner. We say you should invest in equity funds or you should invest in debt funds, and someone at home who's never invested in funds goes online, Googles it, finds something, and then you see that it has the name of the fund and then the NAVs and a bunch of numbers after that. So how do you judge what fund is going to work for you?
Okay, so we'll start off with complimenting Mr. or Miss 23-year-old because we don't know who's he or...
The mysterious 23-year-old who emailed us.
Yeah, that's true. And compliment because at 23 it's a great question to ask. It's the right age to ask these questions. To all those viewers who are watching us, are there in their early 20s, ask the same question. Write as a mail or otherwise also, just Google it. This is the right question to start thinking about it. Coming back to net asset values and mutual funds, okay? Let's get it straight. Net asset value being at 10 rupees at the time of, fund offer, new fund offer, NFO, or at 200 rupees when you are investing like the way today you have addressed, doesn't make any difference.
No differences at all?
No difference.
So I should not be swayed by, oh, NAV is high or it's really low. Is that an indicator of something?
Nothing.
Why do they put it out?
Okay, one thing which is indicator of one, and you should always pay premium to that, is a 200 rupee NAV fund versus a 10 rupees NAV fund is basically telling you the 200 rupees fund has got history and time behind it. So technically to me, if you ask a financial planner's perspective, it's a better fund.
Because it's
a track record.
It has a track record.
It has a track record. It has shown how they have created portfolios over a period of time, how have they performed, how have they done investor servicing, etc., etc. Versus a 10 rupee, which is a new fund offer, which is a new fund offer. That means I'm starting my life at 10 rupees. One is a newborn kid, the other is a mature adult at 200. So even that is not a ideal way of explaining it, but for the sake of simplicity we are doing, at least 200 rupees has got some kind of a track record.
Some kind of experience.
That's true. Having said that, we as investors many a time get confused between this value, and many a time our advisors and so-called agents and other investment intermediaries misuse this confusion which we have in our mind of one being available at 10 or 15, other being available at 200, for us to buy into that cheaper looking fund. And I'm using the word cheaper looking. It's not no difference, because what net asset value tells you is what is the value of that fund's one unit on that particular day. So that means that today it's 200 rupees as a net asset value in the evening, and the other is available at 15 rupees, both are same, because that day's net asset value is that. In case of 15, whatever amount you are investing, let's say you are investing 10,000 rupees, divided by 15, that many number of units you get. In case of 200, whatever amount you are investing, divided by 200 number of units. Now, number of units might be different, one in more, the other is second, but your total value which you are getting is similar. So please, for God's sake, do not get confused. And one of the best things which you need to do, Smriti, which we keep advising people, is get a certified financial planner as your advisor, somebody who's an expert in this line. It's just like a doctor. Most of the times, you don't go and Google this medicine and take it yourself. You go and ask or seek an advice from a doctor after paying him.
Right.
Please do that in case of your investment advisory also. It's very, very, very important.
All right. I want to ask you about a point that you made about people trying to mislead you about the NAVs and try to
True.
prop that up as sort of symbolic of what the fund is. What are the sort of things you should keep in mind when choosing a mutual fund?
Okay, first and foremost, right approach to get into investing in mutual fund is to determine what is the objective, what is the goal which you are trying to fulfill by investing in a mutual fund.
For example, my goal would be I want to have a house in the next 5 years. Would mutual funds be the best way for me to go ahead and sort of start making money, investing money to achieve that goal?
Can be.
Can be?
Because what will happen out here is, let's say, the question which we'll ask you if you want to buy a house after 5 years is, what's the cost of the house which you want to buy? So let's say you say 1 crore rupees, and we'll say, how much is the down payment you want to go and take it? So you'll say, I like to do a down payment of 20 lakhs, out of which 10 lakhs I have, I want to accumulate another 10 lakhs, and 80 lakhs I'll take as a loan.
Yeah.
So now the goal is, in the next 5 years, we need to accumulate 10 lakhs for you. Because it's a 5-year goal, we cannot have a very aggressive asset allocation. Now, asset allocation is a division between how much goes into equity, how much goes into debt, how much goes into commodity like gold. So these are the basic things which we need to take care when
And when you say aggressive, you mean it can't be a very risky thing. You can't put all your money in something that's really risky.
True.
And we know that the stock market's really risky. So
True.
what you do is invest through mutual funds.
What aggressive means is dividing asset allocation into aggressive or rather riskier assets like equity, in which higher return, higher risk, then into fixed income, which is lower return, lower risk, then also into some commodities like gold, etc., which is also, in between debt and equity. Now, risk is there with every kind of investment. Do not get worried with risk, because without risk, you're not getting return. If you want zero risk, go into Government of India, 10-year return is 7%. If you're looking at higher risk, your return goes hand in hand. Idea is to create an asset allocated portfolio which is equally or ideally divided between equity, fixed income and commodity, which will give you over a period of time ideal return which is risk adjusted. And ideal is a word basically coming from a balance between return and risk, which you have to understand is not very easy to manage. Hence you need an advice.
Right. So basically you're saying that even if you want to start investing in mutual funds, always remember that you should have a financial goal. It should be tied in with something. And depending on what the goal is, your investment strategy should flow through that.
And also one more, sorry for butting in, Smriti, I have this bad habit, but important point which I want to really make out here is, many a time I've seen people, they're not comfortable with equity as an asset class. They think, they're not comfortable, even if they have time to do that. I think you should be pretty vocal about it. Tell your advisor, agreed, you are telling me to take an aggressive asset allocation, which is saying take 60% in equity. My whole generation, my whole last 2 generations in families have not invested in equity, and I hate equity. I don't feel comfortable. I think once you make it clear, as an advisor, our role is to make sure we follow your profile. Your scientific profile which is coming out of system, we follow it, because eventually you're saying your comfort is not there with equity.
So don't be afraid to speak up, basically.
Because in that case what will happen is, your goal which you want to do in 5 years, instead of 5 it might become 8-9 years. Somewhere that compromise or a balance has to happen between you as a customer and me as an advisor in terms of allocating a right risk return portfolio based on asset allocation strategy. Once you get your asset allocation right, fit in funds into that.
Okay.
90% of returns, Smriti, comes from right asset allocation.
And that's something that we have learned through the course of the show, is that you have to have your asset allocation right. Otherwise, there's no point. Even if you have the money, if you're putting it in all the wrong places, it's not going to make returns for you. All right, let's take a quick break. We'll come right back and we'll learn a brand new term. Today, the term of the day will be EMI sharing. What does that mean? We'll find out about it after this.